All right, let's get right into it. Today, we're looking at Watches of Switzerland Group. Now, these guys are an absolute titan in luxury retail. We're talking about the premier destination for some of the world's most sought-after timepieces. But, behind all that polished glass in their showrooms, there's a really fascinating investment puzzle that we are going to unpack right now. So, to get started, just look at this number. For fiscal year 2025, the company posted a record-smashing £1.65 billion in revenue. This isn't just some successful company. This is a dominant player, a real juggernaut that is consistently growing and just commanding a massive slice of the luxury market. I mean, this is a business that's truly firing on all cylinders. And yet, that's where we find the central mystery, right? Despite those record sales, despite what looks like an absolutely unshakable position in the market, the company's stock has been completely hammered over the last year. So what gives? How can a business performing this well be seen so cautiously, maybe even fearfully by the market? Well, that's exactly what we're here to figure out. To solve that puzzle, first, you gotta understand the incredible growth story here. This was not an overnight success. Far from it. This is really a masterclass in corporate turnarounds and brand building. A story of how a modern luxury empire was forged from the absolute brink of failure. I mean, just look at this timeline. It shows you just how close the company came to completely collapsing. After the 2008 financial crisis, its parent company went under, and the business was just adrift. But then, in 2013, a private equity takeover brought in fresh capital. And a year later, the retail visionary Brian Duffy came on as CEO. He kicked off this massive transformation that ended with a bold, game-changing expansion into the US and a super successful IPO in 2019. What a comeback story. And that US expansion, it was an absolute home run. The American market, which was once just an afterthought, now brings in over $1 billion in revenue. Think about that. It accounts for nearly half of the entire group's sales now. That single move created a powerful new engine for growth and really diversified their global footprint. But this wasn't just about opening more stores. No. CEO Brian Duffy's strategy, which is captured perfectly in this quote, was to completely transform the idea of what a watch store could be. They created these opulent, experience-led destinations, like their famous Golden Triangle of showrooms in London. They made the act of buying a six-figure watch an event in and of itself. But, and this is a huge but, this incredible success story comes with a massive catch. See, the company's greatest strength, the very foundation of its competitive moat, is also its single biggest risk. It's a relationship you could really describe as a golden handcuff. So here's how that plays out. On one hand, you have an incredible moat. Their exclusive, decades-long relationship with Rolex is something no competitor can just replicate overnight. It's a seal of approval that builds immense consumer trust. But on the other hand, that creates an immense dependency. Over half, let me say that again, over half of their sales come from Rolex alone. That gives the watchmaker enormous power and makes Watches of Switzerland incredibly vulnerable to any strategic shift from its main partner. And then, in August 2023, that risk became painfully real. When Rolex announced it was buying a rival retailer, Boucherer, investors just panicked. The fear was that Rolex might start prioritizing its own stores, cutting back allocations to partners. And just like that, the stock plummeted 26% in a single day. The golden handcuff had suddenly tightened. So what do you do when you're faced with an existential threat like that? Well, management didn't panic. Instead, they accelerated a really clear strategic plan to future-proof the business. And how are they doing that? By diversifying their revenue and cutting down on that critical dependency. Their response is this clear three-pronged strategy. First up, they're pushing hard into high-margin luxury jewelry, acquiring Roberta Coin to basically double that division's revenue. Second, they bought the hugely influential watch media platform Hodinkee. This gives them a direct line to a global community of 22 million enthusiasts. And third, they have fully embraced the booming pre-owned market, with the Rolex Certified program becoming a massive success almost overnight. And, well, this chart just lays it all bare. It shows exactly why that diversification is so crucial. luxury watches still make up about 85% of the business. And while jewelry is growing, it's still a pretty small piece of the pie. The long-term health and maybe even the survival of the company really depends on growing those other segments to create a more balanced and resilient business. Okay, let's get to the bottom line here. With all this context, the amazing growth, the very real risk, and the smart strategic response, what does this all mean for a potential investor? Is this thing an undervalued gem waiting to be discovered, or is it a classic value trap? So the valuation numbers here, they reveal a huge disconnect. Looking at these metrics, Watches of Switzerland is trading at multiples you'd expect from a standard slow-growth retailer, not a dominant player in the high-growth luxury space. The market is pricing in a massive amount of risk. It's essentially betting that the whole Rolex dependency is eventually going to end badly. So this brings the whole investment thesis into sharp focus. The bull case says, look, you have a market leader with visionary management, they're executing a clear growth plan, and you're getting it all at a discount. But the bear case, it counters that the Rolex risk is just too big to ignore, and that any economic downturn could hit luxury spending hard. It is a classic battle between proven quality and perceived risk. And that really brings us to the final, central question. You have a management team that has flawlessly executed a historic turnaround and built a global powerhouse. But can even the best leadership in the world overcome the risk of being so dependent on a single powerful partner? That, right there, is the billion-dollar question that defines this entire investment case.